Hi, everybody. I'm Abe Othman, and I'm the head of data science at AngelList. And I'm going to be talking today about what we saw in the early stage venture capital ecosystem in 2020. First, just a word of introduction about AngelList. AngelList is the world's largest early stage investor. We've made more than 10,000 investments into 6,000 startups. And we recently crossed $2.5 billion in assets under management. Excitingly, we recently announced in our 2020 year in review that we've now, in 2020, we participated in more than half of top tier early stage US venture capital deals. What that level of participation gives us is an unmatched timeliness for our view into the early stage ecosystem. Other data sources, especially given sufficient time, might be more complete. But what's unique about our data set is it gives us a timely capture of the world of venture capital, allowing us to share with you all sort of what happened in the fourth quarter of this year before other data sources are able to report it. So in short, what happened in 2020? 2020 was, of course, a year of extremes, I think, for everybody and maybe every asset class. But for venture capital, what happened in 2020 was that the second quarter was historically bad, and the fourth quarter was historically good. So what do we mean by that? Well, the first thing is just to talk about the way that we think about the ecosystem from our top level perspective is that we're tracking seasoned investments into active startups on a price per share basis. Seasoned means that they've had at least 6 months within the companies. Active startups means we're only tracking startups that haven't been acquired or wound down, and we are tracking them on a price per share basis. And I think that's maybe the most interesting component of what we track. A lot of investors, when they think about early stage or think about venture capital in general, tend to look at headline valuations. But as investors know, those headline valuations always come with some dilution. And so unless you have the price per share and are tracking the price per share over time, you don't actually know if a headline valuation was in fact good or bad for the company, if it represented a significant multiple over the last round or not. So what unique about what we have is this broad scope view into the price per share of all of these startups. How many startups? In the fourth quarter of this year, we had almost 3,500 active companies in our set that we were looking at. Again, and these are seasoned investments, so investments that we might expect to change in valuation over the course of the quarter. The second quarter of this year said it was historically bad. What did I mean by that? Well, it saw the lowest rate of overall activity and a high fraction of markdowns. And one of the most unique trends we saw here was the rise of what we call soft down rounds. So these were down rounds that might be even nominally, in terms of headline valuation, conducted on an increasing valuation basis, right? Say, you raise your last round at a post-money valuation of 100 million, you might raise another round at 100 or 110 million post-money valuation, but because you're taking on, say, 20% dilution, the price per share actually goes down. So these soft down rounds, which we defined as kind of rounds that involved the price per share decreasing by less than 20%, it was essentially unheard of, and we saw quite a few of them in the second quarter. So this is actually something that was reported in the Wall Street Journal. This was an article that got published in September that we originally pitched in July about the record number of down rounds that we were seeing within our data. So Q2, in short, I think what we saw was not a lot of startups winding down or closing their doors because of the pandemic. I think what we saw was founders sort of paying for optionality, right? Maybe they had plans to raise later in 2020. They decided to sort of, hey, let's just raise more capital at the same valuation we just raised at and extend our runway a little bit further, essentially paying for a longer runway. So in contrast, the fourth quarter saw a rebound in activity and, in fact, the highest ever rate of positive activity on the platform. So this bar chart really kind of shows off the data that we saw. Time is going left to right here. So that quarter is on the x-axis, and the count of startups that experienced events is on the y-axis. Good events are going to be in green. Those are like priced markups. And good exits at a positive value at a higher price per share than the last round. And markdowns and bad exits are going to be in red. So, I mean, obviously the trend here is that this graph goes up and to the right, and it goes up and to the right because AngelList has been doing more and more investments over time. So we would sort of naturally expect more and more activity over time, all else being equal. And I think that actually puts into perspective what happened in the first 3 quarters of this year, as well as the fourth quarter. You know, after setting kind of a record amount of activity in the fourth quarter of 2019, the first 3 quarters of this year had lower total activity than we saw in the fourth quarter of 2019, even though we were considering many more startups. And then you can also see by that really massive red bar in the second quarter of 2020, just how anomalously bad that quarter was for startups. Now, what we saw in the fourth quarter, in contrast, is not only do we see a record amount of activity, right? That bar is the highest of anything, which you might expect from the record number of startups we were tracking. But also, in fact, if you do the math on the percentages, it was about 82% of the startups that changed valuation over the quarter changed valuation positively, and that was actually the highest rate of any of these bars. And so that is a really remarkable occurrence for venture capital. I really, I would describe it as coming roaring back in the fourth quarter after not just 1 quarter, but actually 3 quarters of pretty subdued activity. One of the things we've emphasized in our research is actually that there seems to be no correlation between the public markets and early stage venture capital markets. And that's even the case at time lags. There's no kind of consistent time lag. It's not the case that early stage venture capital trails the public markets by 1 quarter, or 2 quarters, or 3 quarters. And I think, kind of to summarize in emojis what happened in the public markets and the early stage venture capital markets, the first quarter was historically bad for public markets, the second quarter was historically good, and the third and fourth quarters were both very good. In contrast, kind of both the first and third quarters of the early stage venture capital ecosystem, they were pretty mediocre, and the second quarter was very bad. But in contrast, the fourth quarter is probably the best one ever. I hope this was informative. Please feel free to reach out to me. My email address is abe@angel.co. Thank you so much.